If you are raising 20 crores, can you make it 15 crores of equity and 5 crores of debt? Or can you make it 20 crores of equity and 5 crores of debt so that you have enough cushion to sort out many imperfections that you have? Having said that, we don't come in at that early of a stage, right? Because the mortality risk is very high and there is enough data to prove that as well over the last 15 years. We come in at maybe one stage or two stages above, and then from there we take it forward. So anywhere from a company raising 30-35 crores minimum to the point of going towards an IPO, that's the stage that we come. The core proposition for a founder is, look, in your entire lifetime of running a company and running a startup, you will raise, let's say, 30 million, 50 million, 100 million, 200 million. Can you probably do it as a mix of equity and debt put together? A classic example in the conventional world is Reliance Industries, right? We all see the lovely parties and sangeets and all that they have, right? But they do have a lot of debt as well. That doesn't mean that they are debt-laden. There's a difference in the way you use debt. As our job is, can we help you complement your next round of capital? If you look at Mukesh Ambani, for example, he took a lot of debt, did a lot of expense, capex, whatever, and then he raised an equity round at 100 billion price. Had he not taken that debt and had he gone to market to raise money, he would have probably got a 50 to 70 billion dollar price. Right? So we try to replicate that in a little bit of a disciplined manner in the startup ecosystem. We've been doing it for about 15 odd years. Thankfully, life to date, our losses are less than 2% over 15 years. So there is a little bit of a secret to the madness, which is largely entry and exit. We put money in Byju's also. Now one may think that, okay, if you put money in Byju's, your money would be like gone, right? But we entered at a certain price, we exited at a certain price, we entered at a certain time, we exited at a certain time. And what we do is, apart from taking fixed income returns, we also take equity upsides, or we take free options to put equity in a company at a predetermined price. That's the sweetener that we get, and that's the model. And the sweetener is intended to essentially balance the risk and return, and hence at a gross level, we would target to make close to 20 to 24% returns for our investors.